Is now the time to stop investing? Are there better things that you can do with your money? If so, what are the things that are better than investing? Because everywhere you look, doom and gloom are on the menu. The stock market has already crashed 25% so far this year, and a lot of people out there will tell you that you do not want to catch a falling knife. You don't want to go and invest in the stock market on the way down, because what happens if you put your money into the stock market now and it goes and collapses down to minus 50% or worse? If you just wait patiently with your money, you will do way better by getting in when the market drops further, by timing it perfectly to the bottom, because the market will definitely fall further. Look, inflation is out of control. Central banks are only just getting started with interest rate hikes that don't seem to be having any effect yet. Unemployment is still super low. People are still buying luxury cars, but a recession or a depression is definitely just around the corner, and Credit Suisse and Deutsche Bank still haven't collapsed. Belarus is about to enter the war in Ukraine on Russia's side. Iran has started supplying Russia with rockets, so who knows? Maybe World War III is around the corner. What kind of an absolute idiot would go and invest money in this kind of scenario? Because only dim twallops would advocate continuing to invest on the way down. Smart people with stacks of money on their tables and Lambos parked behind them will tell you. You might be sitting there thinking, but what if they're right? Should I be piling money into the stock market that's gone down over 8% in just the last month alone? Or is there a better strategy? Are there other things that you can be doing with your money now that interest rates are high? And the answer is maybe. First and foremost, remember one critical fact which underpins every decision you should be making as an investor. You don't know what the stock market is going to do and where it's going to go. Neither does anybody else. That guy on YouTube telling you to sell everything has absolutely no fucking idea. I don't have any idea. Nobody has any idea. Because the thing with investing in the world in general is that things happen, many things that nobody expected. Things take weird turns all the time. This time last year, literally nobody cared about inflation.
You have a price increase, but you don't have an inflation process.
I was making videos about it on my channel, but those videos got no views because it was boring. Inflation was transitory. Stocks were going to the moon. Inflation was going to go away all by itself. Who cares? And this time last year, exactly nobody forecasted a major war in Europe. This year, the biggest energy crisis we've had in 50 years, the worst inflation spike since 1978. Everybody was telling you to buy stocks because 2022 is going to be a great year for investors. Now, fast forward 12 months and you have the power of retrospect. All the same people who told you that they know exactly how good the stock market will be in 2022 are now telling you that in fact they knew all along how bad it was going to be, and in fact they timed it perfectly by selling at the very top because they knew. If you listen to all of this drivel, it is easy to feel like you are inferior. All these people out there know exactly what's happening, but you are the one schmuck who's sitting there with no clue. Because there's this guy who's making shit up as he goes on YouTube telling you that he got it right and you are the clown who got it wrong. So my first top tip, before we get into all the details, to stop taking advice from random guys on YouTube as to which way the stock market or any particular stock is going to go. But to make sure we've dotted and crossed everything, let's go through what you could do instead of investing and what potential pros and cons of each option might be. One obvious place that you should be looking is your debt situation. Over the last 10 years, debt wasn't a thing that many people took particularly seriously. You could go and borrow to the kilter. It was incredibly easy. You can go and build up balances on credit cards. Keep shifting your balance around on 0% balance transfer credit cards costing you absolutely nothing. You could go and get loans for whatever it is that you wanted, get as much money as you want, pay 1% interest a year. Money pretty much grew on trees, but now things are different. Suddenly interest rates started to climb, and we're expecting another interest rate hike in 2 weeks' time, which is likely to take interest rates to 4% at the beginning of November. This means that the cost of funds to lenders is also increasing dramatically, because the credit card company or the loan provider that is giving you the money has to go and borrow it somewhere in the first place. And the cost of borrowing that money on Wall Street jumps as rates increase. 0% credit card balance transfers have already been slashed from 3 to 4 years down to something like 15 to 21 months on the best deals out there, and you'll now have to pay a 5% fee up front on most offers, making them a lot less viable. But it's made even worse by the fact that getting a new loan or a new credit card is also getting massively more difficult than it was. Although wages are still growing, they are growing at a much lower rate than the rate of inflation, which means that people can buy less with their money every month, month after month. But energy bills, food bills, gas at the pump, and rent are all going up by way more than 10% a year. And this means the credit card companies are now baking in significantly higher rates of default into their forecasts. They think that the likelihood of you not paying the money back is much bigger than they did last year. So the likelihood of you being able to get some credit is dropping like a stone. So if you are carrying any credit on flexible rates, paying over 10% for your credit cards, this may be a better place to put your money than investing. Because if you're paying off a credit card with 15% interest, every dollar you pay off your balance is guaranteed to make you 15% return on your money. And I don't know about you, but a guaranteed 15% return on your money in a moment of financial uncertainty is great, even before you consider that paying off your debt means you'll have to spend less on repaying that debt in the future and have more money to invest. It is important to remember that interest on your credit card does not compound in the way that investments compound, because the interest doesn't build up. You are paying off the interest every single month, but the money that you would have spent on paying that interest in the future can then be used to invest, and that is in effect the same rate of compounding, even though it is indirect. Even if your debt is on a low rate now, if you have to refinance that debt next year, for example, it might turn mighty expensive mighty quick. Then you have your mortgage. Most people in the US have fixed rates for the life of the mortgage, which means that at the moment you are probably sitting there on a super low rate despite the Fed increasing rates every month, and that sounds kind of good, kind of easy. Some of you will have mortgages on flexible rates, though, especially if you live in the UK or many of the other countries where fixed 30-year deals just do not exist. And here, you have to be extremely careful. Refinancing a mortgage, just like a loan or a credit card, could become increasingly difficult if the economy worsens. We're all used to doing it every 2, 3, 5 years, however often, but you might have to start paying the standard bank interest rate if you're unable to do it, which is usually some number of basis points above the Bank of England base rate or the Fed rate or whatever. And you might have taken out your mortgage when interest rates were basically at zero. So you might have a deal where the rate is, say, 1% above the central bank rate after your fixed period, and on a mortgage of $300,000 or £300,000, it's all the same these days with the exchange rates. When the rates were at 0.25%, your monthly payment on that mortgage would be $1,000. But when the rate hits 4%, as it is expected to hit in 2 weeks' time, your mortgage rate will go up to 5%, and your monthly payment will go up to $1,610 or pounds, whatever. But what if inflation sticks around and interest rates go even higher? This is quite probable. Well, if interest rates were to go to 10%, for example, to battle inflation, then your tracker mortgage would begin costing you $2,857 a month. And almost all of that will be just paying off the interest. And that's almost 3 times as much as the mortgage was for you just a few months ago. So you've got to think long and hard if you will be able to pay that. It might not feel like a pressing situation right now when you're on your 2 or 3 year fixed term deal, easily affordable, but the moment you come off that, shit could really hit the fan, and you might suddenly need a small boatload of cash just to keep up with your repayments. If all of your money is invested in the stock market and the stock market does take a nosedive by another 30 or 40%, you might not like selling your stocks at the bottom just to keep a roof over your head. So something to think about. But even if you are a typical US household on a fixed term deal, if we hit a major financial crash or go into a recession or whatever, what happens if you lose your job? Will you be able to make repayments without income coming in? How long for? Even worse, might you have to move to find another job? Because if you do have to move, you might have to waive your 30-year fixed rate deal on almost 0% bye-bye, buy, and you might not like what the alternatives are. But let's say you're not sitting on a debt pile. Let's say you are not moving house for the next 10 years no matter what. Is the stock market still the best place to park your money? Are there now better alternatives? Because bond yields are going up, so maybe you want to go and buy some treasuries instead. The stock market might keep dumping on investors for the next few months, but you can go and get yourself a 4.5% return on your money by buying some 2-year or 3-year government bonds. Sounds great, right? Well, on the one hand, it certainly is a lot better than what bonds have been for the last 12 years, basically sitting at 0. And in a few months, those bond yields could be sitting on 6 or 7%, which makes them even more appealing. And if you don't like volatility or risk, you might decide that, hey, bonds are a better place to park your money for right now. You can definitely get a return, it doesn't go down, but there are 2 really critical things that you need to think about before you go bonds. Just bonds. First, remember that bonds do have a price, and if you are going to be buying a bond, if you want to cash in before the end of that 2-year or 5-year deal or whatever, what happens if rates go up even higher? Because at that point, central banks will be in essence flooding the market with new bonds that will be providing even higher yields than the one that you just purchased. And that can create a downward pressure on prices on the bonds that you hold. So if you need to cash out sooner than maturity, you might have to find out the hard way that bonds aren't quite as safe, robust, and stable as some people might tell you. But there is a much more important thing to think about. When you're investing in the stock market, the average rate of return over the long term, assuming all the dividends are reinvested, is around 9 to 10%, depending on what time periods you look at. But there is almost never a year when you actually get a return of 9 or 10%. In fact, the stock market tends to yo-yo up and down, and you are much more likely to get a year with 0% returns or even a minus 10% return or a plus 30% return than a year when you get exactly plus 10%. And here is the chart of the annual returns of the S&P 500 since 1928. Now in 2018, the stock market had a little wobble year and people started to panic a bit, rates started going up, but the very next year after the red year, the stock market went up 28.9%. In 2008, we had the financial crash, a huge minus 38% for the year, and the very next year in 2009, it goes up 23.5%. Here are the 3 years of the dot-com crash, a slow and very painful drop for the stock market, and the very next year in 2003, up 26.4%. You can keep going back as far as you like. Last time we had this inflation spike in 1980, 1981, the market went up 14.8% in 1982. The last time the world was going through a major energy crisis in 1973 and 1974, we got plus 31.6% in 1975. Many of the biggest bars in this chart are the bounce back years after the downtrends, and if you are sitting in your 3-year bond while the market is crushing it, that safe 4.5% rate of return might not quite seem as good. In fact, you will potentially be missing out on some of the best years in terms of investing returns you are going to see as an investor. The falling knife argument says that you don't want to invest in the stock market on the way down because it can fall even further and you will lose a lot of money quickly. And this argument is very commonly used by 19-year-old investing gurus sharing their lifetime's worth of investing knowledge and experience on YouTube, usually alongside some kind of advice to buy crypto, bro, it's the future. But the fact is, over the long term, it doesn't really matter what the short-term stock market movements are. If you are in your 20s or 30s, for example, you might be investing for the next 40 years. In July 1982, 40 years ago, the stock market was 30% down from November 1980. But here is what the next 40 years looked like to today. If you continued to invest every single month, it made pretty much no difference whatsoever, whether you started at that peak, whether you started just before the crash, whether you started right at the bottom, and the long-term return of your total investment over time will be pretty much identical. It's easy to see the news on CNBC, the stuff in the newspapers right here on YouTube and think every day you have to react to what's happening in the stock market. But the truth is, the most successful investors in history all share one simple characteristic. They do not make any attempt at timing the market. They don't try to guess which way things are going to go. You go and look at Benjamin Graham, Peter Lynch, Warren Buffett, anybody else who isn't a trader bro on YouTube, but an actual successful investor who has proven it over long periods of time. And you quickly realize the pattern that the numbers just don't lie. Over the long term, investing consistently through the ups and downs mathematically wins against every opportunist strategy trying to make short-term gains. If you found this video useful, don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.